So what I like to do when I start talking about taxes is I like first to kind of give you a kind of a map of how the taxes work, how all of this works. It looks and some of you will say this is very basic. Look, I've been through this. I've been through a 1040 before. This is just review for you then. So we start out with income, all kinds of income. And I've tried to write this out for you here so that you can maybe save on the notes if you wish. So we start with income, and almost all income, all the money that comes in that you earn from all kinds of sources, whether it be salaries or investment income or rents or your fellowships, certain portions of your fellowships are all going to be income and all subject to tax. There are very few pieces of income that are not subject, and they would be specified in the Internal Revenue Code. One of the popular ones is income that comes from tax-exempt bonds. So a little bit later on, and it might be an investment in your portfolio. Can you invest in Stanford bonds? Yes, you can. And they don't pay very well on the interest, but you actually can buy a piece of the debt of the university. And that interest would be exempt from tax, not subject to reporting. But we first start with all of those pieces of income. So I've left for you investment income and gains, business income, pensions, alimony, unemployment, unfortunately, unemployment insurance benefits. Now you're down with unemployment, they kick you again because it's federally taxable. Start with income. Then from there, we get to deduct certain things that are called adjustments to income. And in this category, we have retirement plan contributions. We have student loan interest, if you qualify. We have contributions to health savings accounts. These accounts are coupled with what are called high deductible medical plans that maybe some of your employers might offer to you. When you have a high deductible plan, you can then contribute money on a tax deductible basis into a health savings account, and that money can be used today, tomorrow, or way out into your future to pay for medical expenses. Moving expenses are in this category. Early withdrawal penalties when you're taking money out of a savings certificate early, they would also be included here. So you come then to this magic number called adjusted gross income. Yes?
Could you clarify moving? Is that like house to house or money from the account to...
So moving in the sense of, I put by their job-related moving. So there are a whole series of qualifications with respect to that, but the idea is that if I'm on one end of the country and my job calls me to be on the other side of the country, 50 miles actually is the amount of moving you have to do in distance, then we're in a job, and we're in that job for a year, or we intend to be in that job for a year, so a permanent job, then we're able to deduct the cost of our travel, the cost of moving ourselves, and the cost of moving our goods. And so those are the deductions that are available for moving expenses. Yes?
Does that apply even if it's reimbursed?
So no, I mean, if it's reimbursed, if that's reimbursed, then it's going to be tax-free. Your employer is not going to count that as extra tax to you. So there's no double dipping. But yeah.
Can you consider that a household move? So like if your spouse gets a job, can you consider all of your moving expenses?
Yeah.
Your partner included?
Sure. I mean, yes, it's the family. It's the cost for the whole family to move. Yeah. All right. So we come to this magic number called adjusted gross income. This is a very, very important number because a lot of things within the tax code depend on this number. And so I'll tell you right now, it's very, very important to try to get this number down as low as possible because it may affect things like financial aid on the outside. It may affect your, another piece of it is the higher this number, the lower your itemized deductions and personal allowances will be. There is a point where, at a point here where the adjusted gross income begins to eat away at these other items. Anyway, that is adjusted gross income, or AGI for short.